Lord Mervyn King, good afternoon and welcome to the DIFC.
Thank you, and it's a real pleasure to be with you.
The pleasure is ours. You're joining, of course, a financial center that's been around for 20 years. This is one of our newer initiatives. We have a podcast series called DIFC Unplugged, and it's a real pleasure to host you. Over the next few minutes, we'd love to pick your brain on a number of topics. You are obviously very well known in global finance and economics. Amongst your numerous academic affiliations ranging from the LSE to Cambridge to Harvard, MIT. I'm sure I've missed a few. NYU, which is where my brother went, of course. You are obviously former governor of the Bank of England. And I'm sure it is a topic that you get a lot, but perhaps we can look back, to your period as in that role and maybe talk a little bit about some of your recollections of the things that you were involved with and perhaps a few defining moments or anecdotes during that time.
So I think there were two big areas I would select. One was the Bank of England being made independent and given the responsibility for setting interest rates and monetary policy. That happened before I was governor, and it resulted in my becoming deputy governor for 5 years. That was one. And the other was what happened during the global financial crisis. So I think on the first one, what was most interesting about it was that we had an opportunity, the then Governor Eddie George and I sat together alone in the Bank of England on the day when we were given independence and talked about what it meant for the bank. And we had basically 3 weeks to create a new system for setting interest rates from scratch. And the staff worked very hard to make that work. And we put in place the Monetary Policy Committee, and it still functions today in very much the same way. So I think that in many ways was the most important moment in the history of the bank since the Second World War. And it was, I think, justified by the fact that we were able to keep inflation low and stable. Obviously, the last 2 or 3 years have not been quite such a happy period, but I don't think that's a reflection on the independence of the bank. And that was really very successful. The second, the financial crisis, I think for me, the defining moment in that was when, during 2008, I had been pressing for a significant recapitalization of the banking system. And eventually we won the argument. The government did recapitalize the commercial banking system. And actually the United States looked carefully at what we had done. And instead of using the money which Congress had voted for them to purchase distressed assets held by banks, they actually instead used it as a way of recapitalizing their own banking system. So I think the two key moments for me were both, if you like, intellectual. One, to win the argument and then implement independence of the Bank of England to set interest rates and maintain low inflation. And secondly, to win the argument for the fact that we would not get out of the financial crisis in 2008 without a recapitalization of the banking system.
So we'll talk a little bit about your current role with Citi, but let's stay on topic for a little bit because you alluded to an era then or a target objective of lower interest rates and low inflation. And you fast forward to today, and in fact, neither are necessarily true for the current duration. We just came back from roadshows in New York and London with a particular emphasis with conversations on the buy side. And there's lots of opportunity, but there's lots of concern about the ability of, deep financial markets, such as North America, UK, and Europe, to try and grow, given that their demographics are challenging. And so in your hat as an economist and with your expertise in policy and your experience in the GFC, where some of these issues had come up, how do you see current landscape, particularly in areas where growth is a challenge, inflation is yet untamed, and it feels like interest rates are going to be higher than before for some period of time. What are your views?
Well, I think interest rates will be higher than they were in the decade after the global financial crisis, but that was an exceptional period. And I think we're coming back to a more normal level of interest rates. So I don't see us going back to close to zero again, except in very exceptional circumstances. I think the big challenges are less on inflation, where I think central banks have maybe belatedly taken action, but they have taken action now, and inflation will come back towards the target. Who knows whether that will mean a sharp slowing of growth or even a recession? Difficult to predict that. But in the medium term, I think central banks can again re-establish confidence in low inflation. And that's their job. Their job is not to do other things. In terms of growth, I think the optimistic position on growth is the following. We inherit a position of very substantial amounts of debt around the world. Sovereign debt in low-income economies, very high debt levels in the G7 countries. In the private business sector, significant levels of debt, which were not tackled during the period of very low interest rates because these zombie companies could continue to service their debt at low interest rates. All that's going to change now. It's a big challenge. A lot of debt will have to be restructured, in my view. Zombie companies will either go out of business or they'll contract. But the resources of people and investment that will be released by their contracting will be available to finance or move into bigger, better, faster growing companies, which will justify the expansion of those companies and will enable productivity growth to go back to the sort of levels to which we had become used, not just before the financial crisis, but actually ever since 1900, where productivity growth in the US, UK, and much of Europe was around 2% a year. And I think that's attainable again. The idea that somehow productivity growth has slowed and we're stuck again in a low productivity trap, I think is a mistake. We have been stuck in a low interest rate trap. Once we get out of that, there will be a difficult period of adjustment as the levels of high debt are corrected. Once that's been done, then I think there's plenty of opportunity for new companies, young companies embodying innovation to expand. Productivity growth will rise. And after all, in the long run, productivity growth reflects new ideas and innovation. And we're not short of that. There are lots of new ideas and innovation around. So I think we can be optimistic about the long term, even if we've got a difficult transition to go through in the next few years.
Do you think that the policy objective of, let's say, 2% interest rate, do you think that that's an arbitrary number, or is the lesson that the expectation has to be managed over a period of time rather than managing to a specific number? And the other question I had is, do you think that we're at an inflection point? You talked about productivity. Do you see AI as providing that inflection point, or is it in essence almost priced in, or is it already embedded, do you think, in how we operate?
I don't think it's embedded in how we operate yet, and I don't think we know enough about it and what it will mean for manufacturing companies, service companies around the world. This is one aspect, and it's not the only thing that's going on. There are many other innovations which are raising productivity or have the potential to raise productivity. On inflation, 2% is arbitrary, but the reason we have a target for 2% is not because there is some magical theory that says 2 is the right answer, 1.8 is not. It's that the purpose of an inflation target is to provide a framework within which central banks have to justify their actions to the public and to the financial community. And if inflation is above or below the target, then central banks have to explain in public why they think that's happened and what they propose, if anything, to do about it. And it therefore is a way in which central banks can build credibility by demonstrating that they have a compelling narrative about how the economy is behaving, which people can assess and judge them on the quality of the arguments. What it isn't is a theory of inflation.
Right.
And I think that certainly in the academic world, many of the arguments have gone seriously wrong because people have said the inflation target is actually a theory of inflation and drives inflation. It doesn't. It's a way for central banks to operate. And what went wrong in 2020 and 21, in my view, was that central banks thought they could print as much money as they wanted in gay abandon, but the inflation target would always keep inflation expectations at 2%, and so inflation would be at 2%. But the lesson of over many centuries history, if you print enough money, you'll get inflation. And I think central banks made a mistake then, but they've corrected it. And I don't think now we're in a position where we're seriously off track. But it's something, central banks have to look at the transmission mechanism. They have to understand that what happens to money, to credit, to banks, to the financial system as a whole matters when analyzing the path of inflation.
Let's change gears for a bit, Lord King. Citi is a longstanding client of the DIFC, a very important player in the region. You are, of course, a senior advisor for the institution. You're also in Dubai, which is a pretty unique place. It's young, ambitious, and growing quickly. Could you maybe shed some light on both your current role at Citi, and if you wouldn't mind, put it in the context of this trip to this kind of new fast growth economy?
Yes. So I'm not an executive member of Citi, and I can't speak for the bank. My job is to talk to both clients, but also the senior management of Citi about what's going on in the world, how to think about it, so that they have an opportunity to put their day-to-day work into the context of what is happening in the world as a whole. And that's clearly very important for a big global bank like Citi, because developments in the world, both geopolitical and economic and financial, are crucial to how Citi operates. So that's my particular narrow role. Coming to Dubai, several things are striking, I think. First one is that Dubai isn't quite as young as you suggested. There are a lot of young people and a lot of energy and enthusiasm, but Dubai has been active in the financial area and working with many institutions for a very long time. And Citi itself will be celebrating next year its 60th anniversary operating in Dubai. So many organizations have a long track record, and so Dubai has built up a reputation which makes it much more likely that people from outside will want to come and work here and operate here. I've been very impressed by the way in which people involved in setting policy in Dubai and creating new commercial ventures think and talk about the opportunities in the future. People have got a clear vision. They've thought through what they think in their own area are the big challenges, how the world is changing, and they've worked out a way for Dubai to play an important role in that. And the quality of the arguments I've heard has been very impressive. So it's been a very pleasant opportunity to come and listen to people who are impressive, and to be able to talk with people in Citi and their clients here about the developments in the world economy.
Super. One of the things about Dubai that's very well known is we're able to attract young people who are talented, who are ambitious. I think your own personal story is quite remarkable, and you can certainly shed light in a personal capacity about your own journey, coming from humble beginnings, with your father being a railway porter and retrained as a teacher. And you've become an industry leader, a highly respected practitioner and academic in the field. It would be great to get some of your words of wisdom or advice for people, young people starting off their careers.
So I think I was very lucky. I was born at a time when I didn't have to fight in the war as my father did. And I had a completely free education all the way through, including going to America on a Kennedy scholarship to study at Harvard. So I didn't have to build up the burden of debt for an education. But I think, my parents My father retrained as a teacher, and they valued education very highly and tried to ensure that I had a very good education myself. And that I owe everything to that. There's no question about that. All the experiences, the opportunities came from the experience of education at school and then university in Cambridge and then going to the other Cambridge to study at Harvard. So I think I would say education is crucial. That's the first piece of advice I would give. The second is that whatever you're doing and wherever you're studying, what matters most is that you really do buckle down, work hard. Because if you're young and people can see that you are working hard, producing good work, successful at studying or successful at work, you get noticed. And then you will be given more responsibility and you deliver on that, and then you can gradually move up. But I wouldn't ignore the role of serendipity in all this. So I never set out to be governor of the Bank of England. And it never occurred to me to be governor of the Bank of England until I was over 40. So I think you have to be open-minded about what you do. I think it's a mistake you can have ambitions and dreams, yes, but you mustn't allow those to constrict what you actually do. You will find lots of opportunities that you never imagined. Take advantage of them, rather than simply say, this is the only thing I plan to do with my life, and then get stuck in a rut when you can't actually achieve that. So be open to opportunities. There are many walks in life that you can make an impact. But education, and that is something you need to continue after school and college. It goes on forever. So keep reading, keep studying, keep thinking, and you'll be amazed at the opportunities that arise.
Lord King, in 2014, you were admitted to the Most Noble Order of the Garter by Her late Majesty, Queen Elizabeth II. What a privilege. For listeners who may not know, including the King, the order can have up to 24 living members. I wasn't aware, by the way, at any time, including members of the royal family. Would love to understand how you felt receiving such an absolute honor.
Well, I was overwhelmed. I had a telephone call from the Queen's private secretary who said in a wonderfully English manner, the Queen has asked me to ask you whether you might conceivably see a way to accepting a position as a Knight of the Garter. And of course, it's such an overwhelming honor that you pause, take a deep breath and say, I probably could see my way to fitting it in. And of course, what's so special about it is that most honours in Britain are decisions of the government. Knight of the Garter is not. The Most Noble Order of the Garter is the oldest order of chivalry in Europe. Goes back to 1346, 48, and it's a personal decision of the sovereign. And the Queen had asked me to come in for an audience after the financial crisis, and then she came back to the Bank of England to meet the staff, especially the young staff who had worked day and night to deal with the financial crisis. And that was very generous of her to give up her time, and it meant a lot to the staff that she came, and it meant a lot to me. And it's a great honour. It's the personal decision of the sovereign, and it's something where you have to live up to it for as long as you live.
Lord King, it was a pleasure and an honor to meet you.
Thank you very much.